Look, I'm going to tell you something that most investment advisors won't admit. If you're over 60 and you lose half your money in a market crash, you're done. There's no coming back. You don't have 30 years to wait for the market to recover. You don't have time to rebuild from scratch. At this stage of life, protecting what you have is more important than chasing the next big winner. And yet, I see retirees making the same catastrophic mistakes over and over again, treating their retirement savings like play money, gambling on stocks they don't understand, and wondering why they're running out of cash. I'm Bill Ackman. I've managed billions of dollars. I've made fortunes and I've survived disasters that would have destroyed lesser investors. And I'm going to tell you exactly how someone over 60 should think about their money. Not how to get rich quick, how to stay rich, how to generate reliable returns in the range of 10 to 12% annually without taking stupid risks, how to sleep at night knowing your capital is protected. This isn't theory. This is what works. Here's the uncomfortable truth. Most people over 60 are invested completely wrong. They've got money in bond funds yielding nothing. They've got money in individual stocks they bought because some talking head on television mentioned them. They've got too much in cash, earning zero. And they've got no coherent strategy tying it all together. That's not a portfolio. That's a mess. And a mess gets destroyed when markets turn ugly. Let me start with what most financial advisors tell you when you turn 60. They say, take your age and put that percentage in bonds. So if you're 65, you should have 65% in bonds and 35% in stocks. That's the conventional wisdom. And it's garbage, complete garbage. You know why? Because bonds have been in a 40-year bull market. That's over. Interest rates were falling for 4 decades. That party ended. Now we're in a world where inflation can spike, where central banks are tightening, where bond yields barely keep up with the rising cost of living. If you're sitting in bonds expecting safety and income, you're going to get neither. Here's what actually happens. Inflation runs at 3 or 4%. Your bonds yield 3%. After taxes, you're losing purchasing power every single year. Congratulations, you're getting poorer in slow motion. That's the so-called safe strategy your advisor recommended. Meanwhile, the stocks in your portfolio are probably a random collection of companies you don't understand, held together by hope and inertia. When the market drops 30%, you panic and sell at the bottom. Then you sit in cash, miss the recovery, and blame the system. I've seen this pattern destroy more wealth than any market crash ever did. The problem isn't the market. The problem is that people over 60 are using strategies designed for 30-year-olds. At 30, you can afford to take risks. You can afford to be wrong. You have decades to recover. At 60, you cannot. One big mistake can ruin the rest of your life. So you need a completely different approach. You need to think like an institutional investor, not like a gambler. Let me tell you how I think about capital preservation and growth. First principle, never lose money. I know that sounds simplistic, but most people don't actually internalize it. They think investing is about hitting home runs. It's not. It's about not striking out. Warren Buffett's first rule is don't lose money. His second rule is don't forget rule number 1. That's not cute. That's survival. When you're over 60, a 50% loss requires a 100% gain just to get back to even. Think about that. If you start with $500,000 and lose half, you're down to $250,000. To get back to $500,000, you need to double your money. How long does that take? If you're earning 10% a year, it takes over 7 years just to recover. 7 years you don't have. So the first job is protecting capital, not growing it, protecting it. Here's how you do that. You build a portfolio of high-quality businesses that generate cash flow regardless of what the economy is doing. I'm talking about companies with durable competitive advantages, companies that sell products people need, companies with pricing power so they can pass on cost increases to customers, companies with strong balance sheets so they can survive recessions. These businesses exist. You just have to know where to look. Let me give you some examples. Think about companies that own essential infrastructure, railroads, pipelines, utilities. These businesses have monopolistic or near monopolistic positions. You can't just build a competing railroad. The barriers to entry are insurmountable. These companies generate predictable cash flows year after year. They're boring. Nobody talks about them at cocktail parties. But they compound wealth steadily and safely. Or think about consumer staples. People need toothpaste. They need soap. They need food. Even during recessions, these products get purchased. Companies like Procter & Gamble or Colgate-Palmolive have been around for over a century. They've survived the Great Depression, World War II, the financial crisis of 2008, the pandemic. They're still here. They're still profitable. They're still paying dividends. That's the kind of durability you want when you're over 60. Now, I'm not saying go buy an index fund of consumer staples and call it a day. I'm saying build a concentrated portfolio of the best businesses you can find, maybe 10 to 15 stocks, no more. You should be able to explain in one sentence what each company does and why it will still be relevant in 10 years. If you can't do that, you shouldn't own it. Here's the next principle. Focus on cash flow, not growth. At 60, you don't need the next Amazon. You need companies that pay you while you own them. Dividends matter. A company that pays a 3 or 4% dividend and grows that dividend by 5 or 6% a year gives you inflation protection and income over time. That compounds into serious wealth. And here's the key, you're getting paid to wait. Even if the stock price goes nowhere for 5 years, you're still collecting dividends. That's income you can live on or reinvest. Contrast that with owning some speculative tech stock that pays no dividend. Your only hope of making money is that someone else will pay you more for it later. That's speculation, not investing. And speculation after 60 is financial suicide. I've made plenty of speculative bets in my career. Some worked, some didn't, but I was doing that with capital I could afford to lose. If you're over 60, you don't have capital you can afford to lose. Every dollar matters. Let me talk about diversification. Most people misunderstand this concept completely. They think diversification means owning 50 different stocks across 10 different sectors. That's not diversification. That's chaos. You can't possibly understand 50 businesses well enough to know when to buy or sell. What you end up with is a closet index fund that underperforms because you're paying higher fees and making emotional decisions. Real diversification is about uncorrelated risks. It means owning assets that don't all move together. Stocks, real estate, some gold or precious metals, maybe some treasury bonds for liquidity. The goal is that when one asset class gets hammered, others hold up or even rise. During the 2008 financial crisis, gold surged while stocks collapsed. During the pandemic, treasury bonds rallied while stocks initially tanked. That's real diversification. But here's the catch. Most people over 60 don't own real estate beyond their primary residence. They don't own gold. They've got everything in stocks and bonds, which means when markets panic, everything in their portfolio drops together. That's not protection. That's correlation disguised as diversification. So what should the actual allocation look like? Here's what I'd do if I were 65 years old with $1 million to invest. I'd put 50% in a concentrated portfolio of 10 to 12 high-quality dividend-paying stocks. Companies with strong balance sheets, competitive moats, and histories of raising dividends through recessions. I'd put 20% in real estate investment trusts that own essential property, medical buildings, data centers, cell towers. These pay high dividends and benefit from long-term secular trends. I'd put 10% in gold or precious metals. Not because I think gold is going to the moon, but because it's insurance against currency debasement and government incompetence. I'd put 10% in short-term treasury bonds for liquidity, money I can access instantly if I need it without having to sell stocks at the wrong time. And I'd keep 10% in cash, actual cash, enough to cover 2 years of living expenses without touching investments. That's 100%. Notice what's not in there. No speculative tech stocks, no cryptocurrency, no penny stocks, no options, no leverage, nothing exotic. Just boring, durable assets that have survived every crisis in modern history. That portfolio should generate returns in the 10 to 12% range annually over time. Some years more, some years less. But the volatility is manageable and the income is real. Now let's talk about what kills most investors over 60. Emotional decisions. You know what the biggest mistake is? Selling when the market drops. I've watched this happen over and over. The market falls 20%. People panic. They sell everything and go to cash. Then the market recovers and they're sitting on the sidelines. They wait for the perfect moment to get back in, but the perfect moment never comes. By the time they reinvest, they've missed most of the gains. Here's the truth. Market corrections are normal. They happen every few years. Sometimes they turn into bear markets where stocks fall 30 or 40%. That's painful, but it's also temporary. Every single market crash in history has been followed by a recovery. Every single one. The people who got destroyed weren't the ones who stayed invested. They were the ones who sold at the bottom. Let me give you a real example. During the financial crisis in 2008, the S&P 500 fell about 57% from peak to trough. If you had $1 million in stocks at the peak, you watched it drop to $430,000. That's horrifying. A lot of people couldn't take it. They sold, they went to cash. They swore they'd never invest in stocks again. Meanwhile, the market bottomed in March of 2009 and began a bull run that lasted over a decade. By 2020, before the pandemic, the S&P had more than tripled from the bottom. If you sold in panic, you locked in a 57% loss and missed a 200% gain. If you stayed invested, you not only recovered, you came out far ahead. That's the power of not panicking. But it requires mental discipline that most people don't have, especially at 60, when every dollar feels precious and every downturn feels like the end of the world. So how do you avoid emotional decisions? You build a portfolio you can live with in a crisis. If your portfolio is too aggressive and it drops 40%, you'll panic. If your portfolio is appropriately balanced with high-quality assets and some defensive positions, a 20% drop won't kill you. You'll be uncomfortable, but you won't be terrified. And that difference in emotion is what separates successful investors from faders. Here's another critical point. Ignore the news. I mean that literally. The financial media exists to generate clicks and ad revenue. They do that by creating fear and excitement. Every day, there's a new crisis. Every week, there's a new stock that's going to change the world. It's all noise. None of it matters to your long-term returns. I've been in this business for decades. I've seen the media predict recessions that never happened and miss recessions that did. I've seen them hype stocks that collapsed and ignore stocks that soared. If you make investment decisions based on what you see on CNBC or read in the Wall Street Journal, you're going to underperform. Guaranteed. Instead, focus on the fundamentals of the businesses you own. Are they still generating cash? Are their competitive advantages intact? Are they still paying and growing dividends? If the answers are yes, it doesn't matter what the headlines say. Hold on. Let the noise pass. Over time, quality compounds and noise fades. Let me talk about fees, because this is where a lot of people get quietly destroyed. Financial advisors charge fees. Mutual funds charge fees. Every transaction has a cost. Those fees compound against you, just like returns compound for you. If you're paying 1.5% annually in fees and your portfolio earns 10%, your real return is 8.5%. Over 20 years, that difference is enormous. $1 million growing at 10% for 20 years becomes $6.7 million. The same million growing at 8.5% becomes $5.1 million. You just gave away $1.6 million in fees. That's not hypothetical. That's arithmetic. And yet most people have no idea what they're paying in fees because it's buried in the fine print. Here's my advice. Minimize fees ruthlessly. If you're paying more than 0.5% annually, you're getting ripped off. You can buy low-cost index funds or build your own portfolio of individual stocks with minimal transaction costs. There's no reason to hand over 1 or 2% of your wealth every year to some advisor who's underperforming the market anyway. Now, let me address something most advisors won't tell you. You need to think about longevity. If you're 65 today, there's a decent chance you'll live into your 90s. That's 25 or 30 years. Your money needs to last that long. And because of inflation, it needs to grow. $1 million today will not have the same purchasing power in 25 years. If inflation averages 3%, that $1 million will be worth about $475,000 in today's terms. You're losing over half your wealth just by standing still. That's why the traditional advice to shift into bonds and safety is so dangerous. It guarantees you'll run out of money. You need growth, but you need controlled, reliable growth, not speculative nonsense. That's why I keep coming back to high-quality dividend-paying stocks. They give you income today and growth over time. They're the only asset class that does both. Let me also talk about withdrawal rates. The old rule was the 4% rule. You could withdraw 4% of your portfolio annually and never run out of money. That rule was based on historical data from the 20th century. I'm not convinced it still works. Interest rates are lower, valuations are higher, future returns might be more muted. I'd be more conservative. I'd plan on withdrawing 3 to 3.5% annually. Yes, that means you need more capital to generate the same income, but it also means you're far less likely to outlive your money. Here's a practical example. If you need $50,000 a year to live and you're using a 3.5% withdrawal rate, you need about $1.4 million in investable assets. If you got that and your portfolio grows at 10% annually, you're withdrawing 3.5% and reinvesting the rest. Over time, your principal grows even as you're taking income. That's sustainable. That's safe. But if you're withdrawing 6 or 7% because you didn't save enough, you're in trouble. You're eating into principal. The first market downturn will accelerate the destruction. Within 10 or 15 years, you'll be broke. I've seen it happen. Retirees who thought they were set, but they were spending too much and earning too little. By their mid-70s, they're back to work, or dependent on family. That's a nightmare you can avoid with proper planning. Here's another thing nobody talks about, tax efficiency. Every dollar you pull out of a traditional IRA or 401k is taxed as ordinary income. If you're in a high tax bracket, you could be giving away 30 or 40% to the government. Meanwhile, qualified dividends and long-term capital gains are taxed at lower rates. Big difference. So part of your strategy should be tax optimization. If you've got money in taxable accounts, Roth IRAs, and traditional retirement accounts, you withdraw strategically. Maybe you pull from taxable accounts first to stay in a lower bracket. Maybe you do Roth conversions in low-income years to reduce future required minimum distributions. This stuff matters. Over a 20 or 30-year retirement, smart tax planning can save you hundreds of thousands of dollars. Let me also address Social Security. A lot of people take it as soon as they're eligible at 62. That's usually a mistake. If you can afford to wait until 70, your benefit increases significantly. We're talking about a 75% increase compared to taking it at 62. If you live into your 80s or 90s, that higher benefit compounds into a massive amount of additional income. And Social Security is inflation adjusted, which is rare. It's one of the best longevity insurance policies you have. Don't throw it away by claiming early just because you're impatient. Now let's talk about risk. People over 60 are terrified of risk. And I get it. You don't want to lose everything. But here's the paradox. Avoiding all risk guarantees, you'll lose purchasing power to inflation. The real risk isn't market volatility. The real risk is running out of money at 85 and having to move in with your kids. That's the risk you need to manage. So you take calculated risks with high-quality investments. You don't gamble. You don't speculate. You don't chase hot tips. You build a portfolio of assets that have survived every crisis in modern history and will likely survive the next one. That's not risky. That's prudent. I also want to address one of the biggest threats to wealth after 60, healthcare costs. Medical expenses can destroy even a well-planned retirement. A serious illness, a long-term care situation, unexpected surgeries, these can cost hundreds of thousands of dollars. You need to plan for this. Long-term care insurance is expensive, but it might be worth it depending on your situation. Health savings accounts are tax advantaged and should be maxed out if you're eligible. And you need a cushion in your budget for the inevitable health surprises. Here's another brutal truth. Most people over 60 are supporting adult children or grandchildren financially. They're paying for college. They're helping with down payments on houses. They're bailing out kids who made bad decisions. And every dollar you give away is a dollar you can't invest. It's a dollar that won't compound for your future. I'm not saying be heartless. I'm saying be realistic. You can't take care of others if you're broke. Put your own oxygen mask on first. Let me also address something that destroys a lot of wealth. Second marriages and blended families. I've seen this over and over. Someone gets divorced in their 50s or 60s, remarries, and suddenly their estate planning is a disaster. Kids from the first marriage fighting with the new spouse, assets getting divided in ways nobody intended. It's a mess. If you're in this situation, you need ironclad legal agreements, prenups, trusts, clear beneficiary designations. Don't leave this stuff to chance or family goodwill. Family goodwill evaporates when money is involved. Now, let me get tactical about the kinds of stocks you should own if you're over 60. I'm talking about specific characteristics. First, you want companies with long operating histories. I'm talking 30, 50, 100 years in business. They've survived multiple economic cycles. They've adapted to change. They're not going anywhere. Second, you want companies with strong competitive moats. That means something structural that prevents competition, patents, brand loyalty, network effects, high switching costs. Third, you want companies with pricing power. When their costs go up, they can raise prices without losing customers. That's how you beat inflation. Fourth, you want rock-solid balance sheets, low debt, high cash generation, the ability to weather a recession without having to cut dividends or sell assets. Fifth, you want shareholder-friendly management, companies that return cash to shareholders through dividends and buybacks, not companies that hoard cash or waste it on empire-building acquisitions. Examples: Johnson & Johnson has been paying dividends for over 60 years and raising them annually. Coca-Cola has a brand that's recognized worldwide and pricing power that's almost unmatched. Visa and MasterCard have duopolies on the payment processing network. Berkshire Hathaway is run by the best capital allocators in history. These are the kinds of companies you want to own when you're over 60. Now, what about real estate? I mentioned REITs earlier. Let me expand on that. Real estate has historically been one of the best inflation hedges. Rents go up when prices go up. Property values appreciate over time. And unlike stocks, real estate is tangible. You can see it, touch it, understand it. But owning physical rental properties after 60 is usually a bad idea. You don't want to be fixing toilets and dealing with tenants at that age. That's where REITs come in. Real estate investment trusts own and manage properties. And by law, they have to distribute 90% of their income to shareholders. So you get high dividend yields, often in the 4 to 6% range. And you get exposure to real estate appreciation without the hassle of being a landlord. Focus on REITs that own essential properties, medical office buildings, senior housing, data centers, cell towers. These are properties with long-term demand drivers that won't disappear. Let me also talk about international diversification. The U.S. stock market has dominated for the past decade, but that won't necessarily continue forever. Having some exposure to international markets, particularly in Europe and Asia, can provide diversification. But be careful. Emerging markets are volatile. Currency risk is real. Political instability can destroy value overnight. I'd keep international exposure to maybe 15 or 20% of your equity allocation and focus on developed markets with stable legal systems. Here's something else most people get wrong: rebalancing. Your portfolio will drift over time. If stocks do well, they'll become a bigger percentage of your portfolio. If bonds or cash underperform, they'll shrink. Once a year, you should rebalance back to your target allocation. That forces you to sell what's done well and buy what's lagged. It's a disciplined way to buy low and sell high without emotions getting involved. But don't rebalance too frequently. Every time you sell, you trigger taxes and transaction costs. Once a year is plenty. Some people do it quarterly or even monthly. That's excessive. You're not adding value. You're just churning your portfolio and creating tax bills. Let me talk about one more critical issue: estate planning. If you're over 60 and you don't have a will, a power of attorney, and a healthcare directive, you're being irresponsible. If something happens to you, your family will be stuck in probate court for months or years. Your assets could be frozen. Your wishes could be ignored. It's a nightmare that's completely avoidable. Get your estate documents in order. Make sure your beneficiaries are updated on all accounts. Consider whether a trust makes sense for your situation, and have the hard conversations with your family about what you want. Don't leave them guessing. I've seen families torn apart because someone didn't bother to write down their wishes. It's tragic and unnecessary. Here's my final piece of advice, and it's the most important. Live below your means. I don't care how much money you have. If you're spending it all, you're in trouble. The wealthiest people I know, people with hundreds of millions or billions of dollars, live modestly. They don't feel the need to impress anyone. They've internalized that freedom comes from having more than you need, not from spending everything you have. If you're over 60, this lesson should be burned into your brain. Every dollar you don't spend is a dollar that compounds. Every unnecessary expense is a claim on your future. Cut the waste. Live simply. You'll be amazed how little you actually need to be happy. And you'll sleep better knowing you're building a margin of safety that can handle whatever life throws at you. Look, I've made billions of dollars in my career. I've also made mistakes that cost me hundreds of millions. The difference between success and failure in investing isn't intelligence. It's discipline. It's the ability to stick to a plan when everyone else is panicking. It's the humility to admit when you're wrong and cut your losses. It's the patience to let compounding work over decades. If you're over 60, you don't need to be brilliant. You need to be rational. You need to build a portfolio of high-quality assets that generate cash flow and appreciate over time. You need to minimize fees and taxes. You need to avoid emotional decisions. You need to live below your means. And you need to accept that 10 to 12% annual returns compounded over time will make you far wealthier than chasing the next hot stock. That's it. That's the whole strategy. It's not exciting. It won't make you feel like a genius, but it works. And after 60, working is all that matters.